Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
You're listening to Real Estate Radio Washington, D.C. Metro with local expert Ryan Sloper. Now, here's Ryan.
Welcome back, Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Cammarosano, the General Manager of HomeGain. Quick reminder, Real Estate Radio is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any questions, concerns, whether it's real estate, credit, mortgage, I'm here to help. The number is 877-245-2030. That's 877-245-2030. Or reach out via the web at realestateradio.dcmetro.com. So we were discussing before we went to break about the revamped Harp, or also known as Making Home Affordable Eligibility Requirements. Lewis, and you asked me kind of, whether this program's going to be any good. And I don't really think that it's going to be any good, but at this point, I'm kind of, what are the alternatives? Because I don't think that the government's going to release foreclosures fast enough for us to actually clear this market completely. So that would be the free market, basically just all banks, once they take a house back, putting it back on the market in a realistic time and letting everything just clear itself out. That's not going to happen. I believe, with Congress and the Fed, with Fed trying to keep interest rates artificially low for an extended period of time, and the government having basically an oversupply of foreclosures that's just sitting there that they want to release slowly and strategically to try not to dampen home values even more than they already are. I just don't see a way to get around this. Do you see what I'm aiming at here?
Oh, I know exactly what you're saying, and also the political will right now is certainly not there. I mean, right now, the first and foremost thing on Obama's mind is getting reelected.
Yep.
So they are going to do something, and this program is what they're going to hope gives some relief. But inevitably, it's not really going to do much good at all except spend some money.
Yeah, and I think that and that's what I was alluding to, is that I do believe that this program is more of a political show than anything else right now. The timing of it is obviously pretty curious. Why didn't this come out, 2 years ago? It would have made a lot more sense, instead of setting 125% loan to value, to just say there is none, because that would have been, my first thing that would have came to my head, is that why even make value become an issue? If you're going to go to 125, why would you just not have, 200?
Well, because you don't want people lending money for something that in excess of what it's worth.
Yeah, but
good lending.
Well, I do agree, but if you're going to go to 125, it's already in wretched excess. You know what I mean? So
what you're saying is, if you're gonna do this kind of thing, you basically have to do it all the way. You can't do it halfway.
Exactly. Yep. And one of the other questions that I have about this program, and I think this will be a major hang-up, is that this is eligible for first mortgages, correct? So if, let's say, a homeowner has a first mortgage with Fannie Mae for $200,000, but they also, when they bought the property, took out a second for $50,000. Well, under this program, they would be eligible as long as they have a job, they can verify their income, and they haven't already taken advantage of this program before. However, they have to subordinate that second mortgage. So let's say it's Wells Fargo holds the second mortgage. You then have to get a subordination agreement. The second lien holder has to agree to let the first lien holder go through with this refinance. Now, Lewis, I'm just going to ask you, what do you think the odds of the second lien holder letting the first one go through are?
Not quite following, because
they have to subordinate their second lien to the new first lien.
Well, why would they do that? That's what I mean.
Yeah, they won't do it.
Right.
9 times out of 10, they won't do it, because it then changes their position. Because when in a typical refinance transaction, most people have to submit the new appraisal to the second lender. They want to see, okay, well, what is it now appraising for? And they'll evaluate if they want to subordinate to the new first mortgage. Well, with this type of program, if they're going to go up to 150% of what the house is worth, once they see that new appraisal, they're going to be like, well, why are we going to do this? This is not improving our position. Even though it is. It would be improving their position because the borrower's interest rate would be better, but the
Because it makes it
collateral
more
is now
likely
worse.
Right, it makes it more likely they'll pay, but the collateral is worse. Okay.
And I think
Wait, isn't the collateral worse anyway, irrespective of the guidelines?
it is. And I think that um, my big hang up is I think that we need to stop judging the collateral as much as the borrowers that are in this in the houses right now. Because if the borrower has been paying for the last 5 years, they probably are more than likely going to continue to pay. And if you give them an incentive with giving them the going interest rates of where they're at now in the 4% or lower range, they're more than likely going to stay in that house forever, or long enough until they can get out of it and break even. Majority of the people that have decided to make the strategic decision to get out of their house by either short sale or foreclosure have made that decision. As time goes on, I think more and more people, though, if they're not able to take advantage of these low interest rates, and once interest rates do head back up,
they're gone.
They're gone. And I think that right now, people are really hanging on to that glimmer of hope that Obama throws out there, that there's going to be a program that's going to be for them. Unfortunately, that's not going to happen because, like we said earlier, a lot of these are private loans that are not owned by Fannie Mae or Freddie Mac. So those people are going to be left out to dry, and eventually when we see interest rates go up, which they inevitably will, we just don't know when, but when they do and they hit that 6% or 7% range, everybody that is still stuck at 5 or 6 or 7%, they're gone. They're letting their house foreclose, and this could be, pushing our cycle of housing further out now from a recovery, I would say, of another 10 to 15 years. I mean, this is really scary.
Let me give you a hypothetical. Even
Sure.
if this does work, and let's say someone takes advantage of it and now they're happy they're paying less. If there's people in their neighborhood who are not able to take advantage of it and they foreclose, the value of the guy's home who's now got to refinance is going to go down, and he may not be happy with that anyway.
Yeah.
So you're chasing the rock to the bottom then.
I do agree with you. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of Home Game. The only issue I have with that, Louis, is I think that really, to be honest with you, the more important thing is securing your long-term cost of home ownership than necessarily your home value.
Yes, we've talked about that. That's right. If you can keep your cost of home ownership down, the value of your home is less important because your rent would be going up otherwise. So your cost of shelter remains at least constant.
And
but it doesn't help housing prices in
No.
the way you think it might, unless it was across the board and everyone was eligible to get that low rate. Because there's other people who won't be able to get the low rate, and they're going to see they're not going to pay, and that's going to drive down the value of homes when they have to go into foreclosure.
Yeah, and see, that's where more with these programs, I'm more concerned, Louis, with the cost of home ownership than I am home values. They're more concerned about their overall thing is they don't want home values to deteriorate too much because
That's exactly right. They are not touting the cost of home ownership versus renting.
Which is what I am touting. I'm touting, you know what I mean? I'm touting that I think that if these programs, if the media was out there pushing that they want to secure low cost of home ownership for everybody out there, that more people would get on board with this type of thing, and it could actually help more people, and people would feel like that they're doing something to benefit them other than just worrying about home values. Which
right. The reason you hold that position is because you, unlike the media and unlike the Federal Reserve, think there's future inflation.
Yes.
And that rents are going to rise.
Yes.
They don't think that that's a legitimate threat, so they're worried about keeping the housing prices propped up. They're not worried. They're not so much worried as you are as the cost of home ownership.
Yeah, I actually I was doing some math, and I basically, showing like the long-term benefits of buying versus renting. And, let's say for assuming a payment of $1,500 for both rent and mortgage, and a fixed rate mortgage, and an annual rate increase on rent of 3.2% for inflation, the housing cost over the next 30 years for homeowner would be roughly $540,000. But for a renter, it could be close to $900,000. And that was just for a rent increase of 3.2% for inflation, which could be low. So I really am concerned about the cost of home ownership, and really it kind of is. It does go hand in hand with property values, to be honest with you, Louis. I mean, I think that we're going to keep if we don't have the jobs to support the amount of houses that are out there right now. The people that are buying these homes are investors and people that have the cash on hand to be able to take these properties down and then rent back to somebody else. So I don't really see any of that changing. To me, letting the free market work would be private investors or lenders getting back into the market that would come up with alternative financing. And when I say that, I know that that's scrutinized with a fine-tooth comb, people thinking like subprime. I'm more talking about people that are self-employed, that make good money, that have $1 million in the bank, but the bank won't give them a $500,000 loan. I'm talking about the person that's got a 750 credit score with 12 months worth of payment reserves in their account, but yet they can't get a loan because they write a lot of stuff off on their taxes.
Those are your stated income loans.
Stated income. I've been the biggest advocate to come back out with a stated income loan, require 20% down payment, credit scores of at least 740, and you must have 12 months reserves in the bank. There's a lot of those guys out there right now, and they would be move-up buyers, Lewis. They would be move-up buyers because they're stuck in their house right now, and they would buy that bigger house and take and potentially sell their house or rent, do whatever they had to do, but they can't because the guidelines are as such as they are right now. They can't do anything. And without coming up with, more, I guess I don't want to say, attractive programs, but it's really the mortgage lending has to start increasing. It has to. And banks need to start making risks again and lending to people. They're not doing their job if a loan doesn't default. Let's just put it that way. They can't take every perfect loan. They're for profit, so you would think that they have to take some risk. When we come back, we'll dive more into that, and we'll finalize more of the revamped Harp program. You're listening to Real Estate Radio.